Insurance as necessity, not luxury.
Health, life, and property insurance were understood as necessary expenses, not luxuries. Families paid for insurance before they paid for entertainment. Families budgeted for insurance. They understood that insurance protected against catastrophic financial loss. They paid for it regularly and without complaint. Insurance was one of the few debts Black families willingly took on, but paying for insurance meant less money for other spending, including borrowing. Insurance protected families from catastrophic debt. It meant families could recover from emergencies without financial ruin. It provided security. 14. The pay cash for cars principle. Cars were purchased for cash when possible, or through very short-term loans that were paid off quickly. Car loans of 5-7 years were considered excessive. Families saved for cars. They bought older, reliable cars that didn't require financing. If they did finance, it was for short periods, 2 to 3 years maximum. Car financing was one of banks' most profitable areas. Long-term car loans generated years of interest payments. When families bought cars for cash or used very short loans, banks made less money. Avoiding long car loans meant families didn't spend a huge portion of income on transportation. They owned cars free and clear, which meant security and flexibility.
15. Business-mindedness, side hustles for income diversification.
Many families had primary employment, but also side hustles, small businesses, services, rental properties. Income came from multiple sources. A man might have a job, but also fix cars on the weekend. A woman might have a job, but also sew clothes for neighbors. These side incomes diversified revenue and increased savings capacity. Income diversification meant less dependence on banks. Multiple income sources meant more financial stability and less need for credit during employment gaps. Multiple income streams allowed families to save more, to create additional assets, to build wealth beyond employment income.
The barter economy, trading services instead of using money. Communities operated on barter systems. Services were exchanged. Work was traded. Money wasn't necessary for every transaction. A man might fix a car for another man who then fixed his roof. A woman might sew for a neighbor who provided childcare. These exchanges happened within communities and extended family networks. Barter meant money stayed out of formal financial systems. Banks couldn't profit from exchanges that didn't involve money. Barter was the opposite of financialization. Barter allowed families to meet needs without spending money. It preserved cash for actual necessities and savings.
17. Extended family financial networks. Informal lending. When a family member needed money, they borrowed from extended family at zero interest, not from banks at high interest. Loans were based on relationship, not profit motive. Family member needed a down payment for a house, an elder relative loaned the money. No interest, no formal contract, just family obligation. The money was repaid because it was family. Family lending networks competed with banks. People borrowing from family meant people not borrowing from banks. Family loans often required no interest, meaning zero profit for lenders. Family lending kept money circulating within communities. It meant families could access capital without paying interest. Wealth stayed in the family. Understanding inflation, saving in real assets.
An awareness that inflation eroded the value of cash. Money saved should be invested in real assets, property, land, business, goods, not just kept as currency. Families didn't just save money, they invested in things, land purchases, home improvements, tool purchases for side businesses. Real assets held value even as currency inflated. Real asset investment meant money wasn't sitting in savings accounts, earning interest for banks. It meant people understood finance and made independent decisions. Real asset investment protected against inflation. It created assets that could generate income or provide security. Financial literacy to children. Knowledge as inheritance.
Financial principles were explicitly taught to children. Children learned about budgeting, saving, not borrowing, understanding debt. Financial literacy was cultural inheritance. Parents taught children to save. They showed them how budgets worked. They explained why borrowing was dangerous. Children grew up with financial discipline already internalized. Financially literate children became financially literate adults. They wouldn't fall for predatory lending. They wouldn't overspend. They wouldn't need credit. Banks profit from financial illiteracy. Financial education created generational wealth. Each generation learned from the previous one. Mistakes weren't repeated. Wisdom accumulated. 20. Homemaking as economic strategy. The value of unpaid labor.
The work of maintaining a household, cooking, sewing, cleaning, childcare, gardening, was understood as economic production that saved money. It wasn't just housework, it was financial strategy. A wife who cooked from scratch rather than buying prepared foods saved the family substantial money. A woman who sewed rather than buying clothes saved money. Gardening produced food. Childcare within family meant not paying for daycare. Unpaid household labor that produced value meant less money flowing through the formal economy. It meant less demand for products and services. Household production reduced cash outlays. Families met needs through labor rather than consumption. This conserved money for savings and investment.
Collective responsibility. Community support systems.
Within extended families and communities, there was collective responsibility. If one family faced hardship, others helped. Collective burden sharing meant individual families didn't need to borrow. A family facing medical bills might receive help from church, from extended family, from neighbors. The community collectively managed crises. Individual families didn't face them alone. Community support meant families didn't need bank loans for emergencies. Collective responsibility meant less demand for credit. Community support prevented individual families from going into debt. It meant resources were shared. Hardship was managed collectively rather than individually.
22. The grandmother, elder authority on money, wisdom over marketing.
Decisions about money were made by elders, grandmothers particularly, who had experience and wisdom. Their authority superseded marketing and consumer culture messaging. Younger family members deferred to elders on financial decisions. If grandmother said they couldn't afford it, they couldn't afford it. Her wisdom was based on experience, not commercial interest. Marketing campaigns are designed to override rational decision-making. Elders with real experience and authority couldn't be manipulated by advertising. They made independent decisions based on actual knowledge. Elder wisdom prevented bad financial decisions. It meant families made choices based on reality, not desire. Generational knowledge was preserved and respected.
23. Avoiding retail therapy. Emotional spending discipline.
An understanding that spending money to feel better emotionally was a trap. Shopping wasn't a solution to sadness, stress, or emotional need. When frustrated, families didn't go shopping. When stressed, they didn't buy things. Emotional regulation didn't involve consumption. There were other ways to manage emotion. Retail therapy is one of the most profitable behaviors for banks and stores. When people shopped for emotional reasons, they often bought on credit. Families that rejected retail therapy didn't provide this profit.
Avoiding emotional spending meant less overall spending. Money wasn't wasted on purchases made for psychological reasons rather than actual need.
24. Being intentional about wants versus needs. The clear distinction. Families made a clear distinction between wants and needs. Needs were met, wants were deferred or rejected. Money was allocated accordingly. A family needed shelter, food, clothing, healthcare. These were prioritized. A want, a new television, a fancy car, status items, was different. Wants could be deferred indefinitely. Consumer culture blurs the distinction between wants and needs. Marketing makes wants feel like needs. When families maintained the distinction, they resisted marketing and didn't overspend. Maintaining the wants-needs distinction meant families prioritized actual necessities. Money for needs was protected. Wants received leftover money only, if any. Building generational wealth. Long-term vision over short-term comfort. A philosophical stance that prioritized generational wealth over individual comfort. Decisions were made with the understanding that they affected children and grandchildren. Families saved for their children's education. They invested in property that could be passed on. They made financial decisions with a multi-generational timeline. Current comfort was sacrificed for future security. Generational wealth building means money stays within families. It means less need for banking services. Wealthy families are less profitable for banks than indebted families. This long-term vision meant generational wealth accumulated. Education was funded, property was passed on. Each generation started further ahead.
These 25 principles represented a comprehensive financial system. Together, they created financial stability and wealth building without consumer debt. Black families in the 1960s understood something that's been largely forgotten. Debt was a trap, not a tool. Borrowing enriched lenders, not borrowers. Financial freedom came from cash, discipline, and restraint. Then something changed. A generational shift occurred. The financial code was broken. Credit cards became normalized. Consumer debt became acceptable. Younger generations were taught that borrowing was smart, that debt was a tool, that you could have things before you had the money. Banks love this change. Consumer debt is one of the most profitable industries. Credit card interest, car loans, personal loans, these generate enormous profit. The financial code that kept Black families debt-free was bad for banking, so it was allowed to disappear. Marketing campaigns normalized debt. Credit became available to Black people in ways it hadn't been before, not out of generosity, but because Black debt was profitable. The result? Black families today have more income than their 1960s predecessors, but significantly less wealth. They're trapped in the debt cycle. They're paying interest to banks for the privilege of consumption. The financial code that created security has been replaced by a financial system designed to extract wealth. The question now is whether we can reclaim it. Can we teach the next generation the principles their great-grandparents lived by? Can we reject the debt trap? Can we rebuild the financial code that created wealth without enriching banks? The answer lies in reclaiming knowledge, in teaching the old principles, in understanding that what worked in the 1960s, cash, discipline, delayed gratification, community support, long-term vision, can work again. Not because it's trendy to be debt-free, but because it's the path to actual freedom and wealth.